Let's begin this wonderful Monday morning. We are talking about personal finance, right? Any questions about last week or about the final exam? Have you figured out your schedules? If you need a special exam, I see some heads nodding. Let me see a vote of hands if you need a special exam before the end of the year. 1, 2, 3, 4, 5. Okay, well that's the 5 I need to do more work. Thank you. Okay, so let's start. We are talking about personal finance. It's important for everyone to get a realistic view of their personal finances. For this, I'm going to upload for you a group assignment. I'm still working on making it shorter and simpler, if learning from last year, that will guide you through building an Excel spreadsheet which really simulates realistically the wealth as it accumulates over the years of a person that starts as being employed and then goes into retirement, that is living off the interest that is accumulated capital is producing. And so to build this, you have to start with a budget, right? And we've gone through some of these items, so we can skip. Okay, when you talk about a car, you have car insurance, car depreciation. The depreciation, you have this table here. You have to take into account that the value of the car decreases every year. You got to take that into account. You can either think about the value decreasing every year, which is true, but you're anyways not earning interest on the capital that you've sunk into the car. So you might as well think about when you buy that new car every 5 or 6 years, then that's what, to bring yourself back up to the standard of a car that you've had or higher, then you're going to have to pay up the extra, right? And you might as well depreciate that over time. So these are two different ways of thinking the same thing, depending on how your cash flows really go. You'll notice these things when you start your saving and investing, if you really get into the habit of investing every cent or rapping that you don't need. If you don't, if you just keep 100,000, 200,000 on your cash account, because that's what you get from your salary and just accumulates, then you're never gonna get into these details of cash timing, okay? If you buy things up front or if you pay as you go, the difference is the interest that you might earn on your capital if it's in your hands or whether you prepaid, okay? If you just keep $200,000 in your cash konto, these things really don't matter because you're anyways not maximizing your capital. But in this course, I want you to think like the Rich Dad. You know that book, Rich Dad and Poor Dad? You don't need to read it. Just you can Google it and see some video. There's a ton of these videos online. Just see some video to get kind of this feeling for this module of the course that you're really trying to reach your financial goals and live off the interest. When I say interest, that includes also capital gain. Okay, live off the return on your accumulated wealth. Yeah, you gotta pay for the tire store and change. You have this thing where the summer tires, winter tires, and then they scare you about the insurance not covering if you're driving summer tires in the winter, which is true. But you have all year tires, you have all season tires. Anyways, you can save some money this way. I looked into it when it mattered to me. Okay, car repair. The highway sticker, you gotta pay for the highway sticker if you're driving a car here in Switzerland. The license plate fee, this thing nobody anticipates, but when you buy a car, you save up, you're so excited, you get your car, then bam, you get in the mail 500 or 600 franc yearly bill to renew your license. Okay, it's just a tax per car. You gotta put that in your Excel spreadsheet. Personal liability insurance, we can talk about that a little bit later. Okay, durable depreciation. Okay, your laptop, this is the one thing that I can give you a hint already after you have this Excel spreadsheet. If you buy a new laptop as you really need it, you know, as soon as your old laptop gets you know, slowed down by either virus or because it's too old or for whatever reason, if you just buy that new laptop, as soon as the old one gets slow, this doesn't really make a difference on your final retirement age. But if you buy a new car every 3-4 years, as opposed to buying a used car every 5 or 6 years, that makes a difference in your retirement age. And the biggest difference we're going to discuss soon is whether you buy an overly sized house. That makes a huge difference on the age when you can retire. And you'd be amazed that I'm going to tell you some stories, but people really cannot understand this basic calculation because they are so emotionally attached to this huge mansion that their wife or husband, stay-at-home wife or stay-at-home husband, convinced them into buying. So yeah, go ahead and buy that new laptop if your old laptop is not fast enough. That's my recommendation. Furniture, yeah, that's up to you, but some people spend a lot of money on furniture. You might want to put that in your Excel spreadsheet. Okay, accountants and lawyers, you gotta pay them sometimes when you get more complicated issues, but yeah, maybe if you take this course, you don't need an accountant, because you can figure it out yourself. And if you've listened to me, then you wouldn't need to pay so much to lawyers. That's a big lesson that you start kind of taking on to yourselves. If you ever start a business, or if you ever have any kind of legal issue, wait. Don't pay the lawyer just yet. Just call another lawyer, and then the next lawyer, and then the next lawyer. You can get them down by a factor of 10, really. You can get a first quote to be 10,000, the last quote, maybe the next day or 2 days after your research, you might get a quote because you are not much more informed about this topic. You can get a quote for the same job for 1,000. Really, that would be the difference in quotes for any kind of legal work. Inflation rate, we're not going to discuss too much inflation, but just to give you an overview of the history of, you know, what really happened so much far back. I don't know how applicable this is to anything in the future. Maybe if you're kind of an economic historian, which I don't really recommend you become if you want to, you know, be the rich dad instead of the poor dad, and if you read that book. But you see recently in the last 10, 20, even the last 20 years, inflation has been between 2 and 0 or so, or slightly negative. So that's the yearly inflation rate. Okay? So it's not really such a big issue. Okay? Taxes. Who here loves taxes? Nobody. I see some smiles. Maybe it's funny, almost. My jokes get better, trust me, okay? My jokes can get better. Yeah, this is a good resource. In Switzerland, you have to pay your federal tax, your canton tax, and your Gemeinde tax, right? And there's the church tax. I don't know who would even, you know, unless you're a religious person, that's kind of irrelevant. But that's more like what you call it, like a donation, right? That you sign up for. because it's voluntary. There's competition between the cantons and the municipalities. Even inside a canton, there would be competition between the different Gemeindes on attracting the people by giving them a lower tax rate. Okay, you guys know this, right? And that's really a good thing. That's really a great thing that you can move a few kilometers here or there and get a lower tax rate. And you got your pros and cons, and you can think about it. Yeah, bringing in competition to taxes. Who would have thought that's possible? That's really great. The municipal tax is a fixed proportion of the cantonal tax. So it's the same kind of, it's a very simple calculation. So for the federal tax, you have the brackets, depending on how much money you're making, then you need to pay a different tax rate, okay? And same thing for the cantonal, they have the brackets, but then for the municipal, they say, we don't bother with these calculations, we just say, whatever is your tax bill for your cantonal, we just take a proportion of that. If it's 100%, then you need to pay us the same amount that you pay the canton. If it's 79%, you need to pay 79% of whatever it is that you need to pay to the canton based on the brackets. Just see, those windows don't open, right? Some ventilation here. All right. It matters if you're single, married, if you have children, the tax rates that you're going to pay. Married people file together. Okay? So two earners, if you're married, then they sum up your earnings, and then you need to pay as if you're one person. Okay? So that means that you easily reach, if both of you are employed, you easily reach a higher tax bracket. And for this reason, right? They can't have it both ways, so they give married people a lower tax progression schedule. Okay? So on $500,000 a year earned by a married couple, they need to pay less tax if it was an individual, a single individual making $500,000, because they're actually two people, so maybe they're making $250 and $250. So it would be a lower tax rate. You can look into this. Okay, dividend and interest income are considered ordinary income. Okay, you need to pay tax on those as if they were your regular income. Okay? So why is that the case? I don't know, but you can start thinking. And on the contrary, capital gains is tax-free in Switzerland. In most other countries, capital gains is taxable. In Switzerland, it's not. And you might want to start thinking why everywhere they've decided to differentiate between the two. Say interest income, we're going to tax, and dividend income, we're going to tax. But capital gains, we're not going to tax, or we're going to tax at a lower tax rate. So everywhere, it's the case that the capital gains tax rate is lower, and in Switzerland is actually zero, than the tax rate on dividend and interest income. Okay, one of the things about interest income is that interest gained is interest paid by someone. Okay, and this interest paid by the someone who's paying it is usually tax deductible as an expense. So whoever is paying that interest needs to pay less taxes. So it's only fair that someone in the economy that's receiving this interest would have to pay taxes on it as if it's taxable income. Yeah, that's one of the reasons. Maybe another reason, and I haven't reached it here, it's on here somewhere, is that capital gains on real estate is taxable, even in Switzerland. So why might that be? Maybe there's two things I could think of why they decided over time that they want to say real estate is going to be different from stocks and bonds and sorry, not bonds, but stocks and private equity, that if it goes up in value, or gold or Bitcoin, if you buy it and it goes up in value, that's all considered capital gains. You don't need to pay tax on that. But if your house appreciates and then you sell it, or you buy a house for investment, a second home for investment, and the value increases, then you sell it, then on that capital gain, even in Switzerland, you do need to pay some sort of capital gains tax as it relates to real estate. So one thing is kind of the social kind of philosophy that they don't want people to buy so many houses to drive up the price houses higher so that the regular folks can't even afford a house. So that's maybe one consideration why they've decided to put a capital gains tax, even in Switzerland. And another issue is that the profit from real estate investment is that much more certain than even the payment on some corporate bonds, and certainly more than the capital appreciation of something speculative like Bitcoin or gold, or even more than the expected price appreciation of stocks, which are quite risky. So the more kind of certain it is, real estate is quite a certain profit that if you hold it for long enough, it's going to produce a capital gain. Then that's another consideration that I think, I haven't read it anywhere, but it's pretty obvious to me that the government is looking to, take money from the public where it hurts least and where it's most stable. Then it's obvious that they might want to treat real estate somewhat in a different manner because it's just that much more certain that on the aggregate people make their money on real estate price appreciation. So they kind of want to tax that more so than they want to tax, say, any price appreciation on something speculative. Think of some very speculative investment. You've made like 5 of these, then one of them really went up, but you lost money on the others. Then maybe they say, well, let's not get into what's offsetting losses against that one gain. Let's just not tax anything because it's so speculative anyways. That's one way of thinking about it. It's not critical for you to but just some people like to think about it. If we're talking about it, then it's interesting. You can click this button to actually calculate your taxes. I had it here somewhere. So this would be the output from that link. So you can enter so let's say this is a married couple which are both employed. They own their own household. The first earner's income is $200,000 a year. The second earner's income is $100,000 a year. They have $10,000 interest income from some bond that they purchased or some dividend on a stock that they've purchased. And this is their total taxable income. Okay, and then all these deductions, let's discuss these quickly. This is the total deductions allowed. See, it's different what is allowed between the cantonal calculation and the federal calculation. It's not this exact, most of them are the same, but here, for example, what insurance deduction is allowed, you're allowed to deduct more against the canton, less against the federal. There must be an explanation why this is the case. And then you reach your taxable income. This is the most important figure to calculate when you're calculating taxes. Okay, that's a term you want to consider. Remembering taxable income. So you start with your gross earnings, and then you're allowed to reduce from this amount all these deductions for what you've contributed to the pension plan, and deductions as per how many kids you have, and so on. And for health insurance, you're allowed to deduct, and some interest on debt loans. If you took some personal loan, then you're allowed to deduct the interest payment, just like I mentioned. So you're allowed to reduce that from your taxable income, and then you reach this final amount, and this is the amount to which the tax brackets are applied. Okay? You put this into the function that calculates how much you need to pay on the first thousand, on the second thousand, on the third thousand, and so on and so forth, and then you get the final amount. So this is how taxes work. So you get your tax bill for the federal, then you get your tax bill for the canton, and then for the Gemeinde is just a proportion, in this case 100%, because I chose the city of Zurich in the canton of Zurich, and then you need to pay these, no, sorry, it's 119, and so this is what you need to pay the canton, and this is what you need to pay the city, and this is what you need to pay the federal. And altogether it would be this plus this plus this would be this amount. And you can do this very, very easily on this link, which is cool. I don't even know any other such nice calculators. They have some in the US, but they have them everywhere, but yeah, questions are?
No problem. Do you know the percentage which you have to pay for capital gain for the real estate? Like,
I forgot. I didn't write it down, and it varies also between the cantons. So maybe you can Google it and let us know next week. Yeah.
I think it depends how long you hold your property.
Sure.
At least in Bern, it depreciates
Right.
over time. So, I mean, if you buy and sell right away, it's about like 25%, and then it slowly goes down.
Makes sense. Makes sense. All right, a little bit about the deductible items. We go over them quickly. The pillar one, Ahavak, the Social Security plan contributions. So whatever your employer and you contribute to the Ahafav, yeah, to the Social Security pension plan, in that year is tax deductible. So if you made 100,000 income, but you've contributed 3,000, let's say 4,200 to the pension plan, then you only need to pay, your taxable income is 9,500, 95,800. Okay, that would be your taxable income. Your taxable income would be reduced by the amount of the allowed deduction. Same goes for the pillar 2 and the pillar 3. So whatever you contribute into one of these pension plans that you have, and this mechanism is similar almost in every other place, because they all figured out from each other that this kind of works for the people, and that's why most of the countries have the same mechanisms, maybe in different parameters, different tax progressions, different things that are allowed and not allowed, but mostly it's very similar between the countries, just different numbers, okay? It could be a very big difference if it's 20% tax rate or 40% tax rate. This could be a very big difference, but it's the same concept of progressive tax brackets that all the different countries adopted to themselves, because it kind of works and because they copied it from each other. So whatever you contribute into the pension plan, you don't have to pay tax the year of the contribution. Okay? And that's a great thing. So think about it. If you've contributed the maximum into pillar 3, the 6,700 something, then you don't need to pay tax on that amount that year. Okay? So we can discuss that in a second. So this is another kind of incentive that the government put into place for you to save money for your retirement via these kind of approved instrument for savings. You have the disability benefit insurance. If something happens that all these years you've contributed a little bit and they have quite a nice pot for people who, you know, God forbid something happens to them, they can't work because of some accident or some illness, then or loss of income insurance payment. Yeah, this kicks in, I'm not sure under which circumstances, after you've exhausted your unemployment insurance payments, or maybe together with your insurance if you're not making enough money from your unemployment. Look into this, maybe one can explain to me how this EO actually works. But the unemployment insurance, that is kind of similar everywhere. Okay, you pay into a fund while you're employed. You pay a certain proportion of what you earn into this state-managed unemployment fund, and if you become unemployed under the rules of the fund, then you get your unemployment benefits. Okay, so it's the same in every country. The main difference is how generous and how well funded this pension plan is. And I can tell you that in Switzerland, it's by far the most well-funded and the most generous plan there is. Okay, you get. We're going to discuss this in a second. Question?
I want to say, I think the loss of income insurance payment, also the EO, is facultative insurance you can pay into while you're working, and then when you lose the job, you have like 1 year or 2 years, depending on how much you pay during your working time, where you get like 60, 80, or 100% of your normal income from the job.
That's the LV. That's the
No, I
unemployment.
think that's like forever, like that's the rough. Like when you don't find a job in 5 years, you're
Yeah.
still getting the LV or ALV. But I think the EO is like a temporary facultative version.
I think it's other way around. I'm pretty sure it's other way around. The ALV, Arbeitslosenversicherung, this is the temporary up to 2 years that you get based on maximum 70, or if you have children, up to 80% of what you were earning while you were employed. But you get it up to maximum of 2 years or so. And the EO is under some extraordinary situations where you cannot make even after that, I think. And no, the social help, that comes from the AVA. So if you're really needy and cannot get a job, cannot work, even after you've exhausted your pension plan benefits, your unemployment plan benefits, then you become a social help case, and that's again in Switzerland the most generous that you have anywhere, and it goes on forever, and that comes from these contributions. So this one is really, I'm not really sure what it covers, but it's some kind of a case, some cases. You can read into that. It's not so complicated.
So you already get money from the AIHB before you go into pension? I mean, don't you only get the rent when you go into early pension or in the ordinary pension? If you
Maybe
lose
you're
your
right.
job at 40 and you can't find another job for 20 years, I understood that you explained then after a certain time you get paid from the social part of AHB.
Right.
But doesn't AHB only come in the early pension or in the ordinary pension?
It could be. You know what? I'm not sure. I don't want to mislead you. I'm not sure where the social Hilfe is coming from, but I'll answer that next week. Okay? Should write it down for myself. Write a pen.
You want one?
Yeah. Piece of paper, maybe.
That sounds different.
I think it compensates the loss when you do military service. And since July 2005, also for the women when they have children and they have their like child vacation.
Yeah.
So that's EO.
Okay.
Compensates
Okay.
this, I think.
So EO is for some special cases if you go
Yeah.
on maternity leave
Yeah.
and the employer is not covering that, or okay, or if you go in on military absence, and again if your employer doesn't cover that, and then so this is for sure the regular unemployment benefits, and then if guys maybe you don't want to know all the rules, but because this maybe demotivates you, but worst case, if you have zero money in the bank and no job, then you can become a social help case, and then you get money from the government. It's not much, but it's not bad, and it goes on forever. And I'm pretty sure that this comes out from the AHFL pool. Okay? Health insurance payment, that's also deductible up to a maximal amount. Okay, so what you pay your insurance company for your health insurance, then that amount is allowed to be deducted from your taxable income that year, up to a maximum amount. Work-related expenses, so again, up to a maximum amount, perhaps as a function of your income, you're allowed to deduct against work-related expenses, like, sometimes you need to take, a taxi or an Uber or something that your company doesn't pay for it, but then the government allows you to kind of deduct this up to a maximal amount from your taxable income because you're employed. It's not that substantial, and you don't need to show receipts for that. Okay, it's just kind of a standard deduction. Property maintenance costs, we discussed that up to 0.7% of the value of the house per year, you are allowed to deduct if you've actually expensed that money on renovating your kitchen or fixing something in the house. You're allowed to deduct that against your taxable income. Up to 500 francs a year, charitable contributions with no receipt. So you can say that you've contributed 500 francs. Hopefully you did, but even if you didn't, you don't need to show receipts. You're allowed to, you don't get the money back, okay? You just pay less tax. It means that if you made 100,000, if you made 100,000 income, then you're allowed to deduct 500, then you only pay taxes as if you made 99,500. You don't get the 500 back, but you just pay a little bit less tax, as if you had this actual expense. And hopefully you had this expense, actually you didn't cheat the government. Second earner deduction, okay, so in addition to a married couple filing together, and then they have their own kind of schedule of brackets that's kind of lower because together they're a richer person than individually, they get also like a special deduction. You just reduce a certain fixed amount. Okay, so there's different ways to play with it. You either reduce or you have different brackets, so you can play with it in different ways. And it's a formula, and then you get the final amount, which is the taxable income. Then you get the final tax bill. And interest expense, if you get a bank loan or your mortgage interest, okay, these are tax deductible. Okay, so you're allowed to reduce them from your taxable income, except in most countries, credit card debt. Okay, credit card debt is considered a consumer product. So it's as if you were sold on some magical product and now you pay interest on that, and because it's just like a regular product that you buy, then you're not allowed to deduct that as an expense. I don't think that's fair, but that's how it is in most countries. Not sure about Switzerland. I'm not sure if this relates to Switzerland or the United States. Yeah.
What about educational expenses? If I work, for instance, and I'm taking on part-time studies and I have to buy books for that, is that deductible as well?
I don't think so.
Yes,
Yeah, it is. Maybe.
I just
Maybe.
did it.
Okay, good. I should have this. Yeah, maybe a piece of paper for me. Oh. Yeah, nice. So these things can save you taxes, so you want to get familiar with these. It's not such a big deal. It doesn't really save you so much money. So let's say by investing a little time to learn these things, then you find out some deduction for, let's say, even $10,000. You're not going to find a deduction for $10,000. So let's say something realistic. Let's say maximum $2,000 or Swiss francs that you figured out that you can deduct, which you wouldn't have known unless you did your homework and research. So let's say you found 2,000 more you can deduct, which is really quite a large amount, because most of these deductions are kind of automatically kind of populated in the field when you file your form. Then if you do it online, then you get those deductions kind of automatically for the health insurance and so on. You don't really need to know about them. They're kind of done automatically for you. But let's say you find out that you can deduct some books or some other this 500 charitable contribution. Then let's say 2,000 times maybe 20 or 25% marginal tax rate. Then you've saved, what is it, maximum 400 francs a year. So it's nice, but it really doesn't make such a big difference. Yeah, capital gains tax. So I mentioned that if you buy some Apple shares and these go up in value, then when you sell them, or even I think before you sell them, at the end of each year, you need to calculate the difference, and that would be a capital gains, which you wouldn't need to pay any taxes in Switzerland. So it doesn't really matter if you realize the profit or you didn't realize the profit. In some other places, it matters if the profit was realized. So in places where capital gains tax is positive, so in places where you need to pay capital gains, then usually it's the case that you only need to pay the tax when you realize the investment. So let's say you bought some Apple shares and you've held on to them for 1 year. You've held on to them for 2 years. Okay, so at the end of the first year, maybe you've had a capital gain, but it's an unrealized capital gain. So you don't need to pay tax. Until the end of the second year when you sell it, then you take the entire gain over the 2-year time span, and that's taxable capital gain, where capital gain is taxed, and you would need to pay the tax in its entirety in the second year. Okay? So that is usually the case with capital gains. And let me tell you, that makes things harder for accountants, because if you are, if you are managing money for people, and then you need to report to them what they need to pay as taxes, otherwise the whole thing doesn't work, right? They give you the money, you invest in certain things, but the way you report to them doesn't allow them to pay their taxes, then they get in trouble. So then they wouldn't invest to begin with. They want to make sure that you can provide the right information for them to pay their taxes as they need. And in places where where capital gains is positive, then you have to keep track of the timing of things. Okay. And furthermore, they might, in the United States, they separate between short-term capital gain and long-term capital gain. So they say if you bought your Apple shares and you sold them within the year, you've held on to them for less than 1 year, then that capital gain is taxed as ordinary income at a higher tax rate. If you've held on to them for more than a year and sold them, then that entire capital gain is taxable at a lower tax rate of 20%. So that means you need to keep a timestamp on every trade. It means you need to remember when you bought these things and when you sold them, and if it's more than a year or less than a year. And this timestamping makes the accounting of everything much more difficult. This timestamping is really the one thing that I think that they can do without, because just for this reason why it's so complicated to keep a timestamp on everything, I would definitely cancel that if I had a direct line to the president, but I don't. Any questions about taxes so far? Yeah.
It's a really question, but to explain how it is in Switzerland. In Switzerland, when you invest into Apple shares or whatever as a private person, there are like, I think, 5 rules, also like from Jura, you have to fulfill to have to pay taxes for the capital gain. Like you need to frequently buy and sell. You need to be over a certain amount, and you need to have a certain amount of Fremdkapital, also debt, like money from the bank to buy the shares.
Right. So you're talking about being taxed on your capital gains if you are a trader. This is called a trader versus an investor. So if you bought your Apple shares and this is not really your business. Yeah, maybe you think yourself so highly that you are such a talented trader, but then this is your profession, but really the tax authorities, they don't see you as a professional trader, they just see you as an investor. You bought them, and after a while you intend to sell them. Let me just finish this thought. So then you don't need to pay taxes on that capital gain because you are considered an investor for tax purposes. If you are considered a trader for tax purposes, that is, if you trade so frequently, if we trade with so much money, if you rely on the income from trading exclusively as your livelihood, or if you borrow money in order to finance this trading, then in most cases the tax authorities would consider you a trader, and then that capital gain would be taxable as ordinary income, right? So that's an important issue. Let me add this. So let me just finish this page and then we can take a 5-minute break. The wealth tax. This is the cool Swiss tax that they've invented. I think it makes total sense that they would count your taxable wealth and say, well, as a function of how much wealth you have, you need to pay tax, wealth tax. It's not so much. I think it ranges from up to a maximum of 0.3% of your wealth that you need to pay as wealth tax. And I think that makes a lot of sense. Pension assets are excluded from this calculation. So if your total wealth is 3 million, but you have 1 million in your pension plan, then your taxable wealth, the wealth for the purpose of the calculation of the wealth tax, would be just 2 million. Okay? Your property is included net of the mortgage. All right? So the value of your house less the mortgage that you own is included in your wealth tax. Inheritance or death tax, I don't know how bad this is in Switzerland, but they have it in all sorts of places. Oh, I read that you have this in Switzerland. So, again, when you pass away, you give your money to your kids or to your friends or to, I don't know, to some charitable then you need to pay tax on that. And in Switzerland, they're clever about it. They say if you just bequeath it to your kids, then you pay a low tax. If you give it to your friends, it's a higher tax. If you give it to a charity, then I'm not sure, but I assume it's a bit of a higher tax than if you give it to your kids, or maybe not, I'm not sure. All right, so let's take a 5-minute break. All right, so let's move on to talking about property. This is really important. The decision to versus whether to rent or to own. A lot of people get this wrong. Let's get to that, and I'll give you some examples. Lots of people talk. This whole thing, finance and money, especially when you throw in economics into it, then it's really becomes confusing and source for arguments, and then the facts never get revealed. Well, one of these things is people start saying that nobody rents in Switzerland. They say everyone owns in Switzerland, or they say everyone rents in one place or another. But that cannot be true, because someone owns each and every house or apartment everywhere. Okay? Each and every apartment or house is owned by someone, whether it's an individual, a company, the government, or the church. The church, by the way, they have lots of properties all over the world for a very long time. So it's a fact that real estate is owned by someone, unless it's on the moon. Even on the moon, they've allocated some land to some people. Okay. Transaction costs. The bid-ask spread is huge. Okay. It's not like Apple shares. You can buy and sell them if you change your mind after a minute and sell them for just a tiny amount less. Okay. The bid-ask spread, the price at which you can buy the house, is usually higher than the price at which you can sell the house or any property. It's just because you need to find someone to buy or sell it to or from. So this is a cost. Okay, if you buy a house and you change your mind because you broke up with your spouse, now you want to sell it, then if you do that within a few months, you try to sell it for the same price, forget it. You're not going to be able to sell it for the same price. Registration fees, that's not such a big deal. You have to pay the government a little bit for the title ownership change. Okay, there's a central database where the ownership of the houses is kept. Okay, and the land. I'm going to add this actually. There's a thing called the land register, and that's an important thing for the rest of the class, because you're going to see that money, the ownership of money, is kept somewhere. This is the biggest secret that nobody ever teaches you. They teach you about economics and law and theories and about growth and all sorts of very complicated things. They don't even know where and how the ownership of money is kept. It's quite simple. I'll explain it to you. And similarly, land has a registry, right? It's kind of a social good that all of us as society would find it beneficial if there was an entrusted kind of entity such as the government or one of its kind of subsidiaries to keep track of who owns which land, so as to avoid disputes over who owns this piece of land. And when a person sells a house with the accompanied land to another person, then they would need both to approach this land register and arrange for the change of the name next to the plot of land. And this has a fee involved. It's not so large. Yeah. Broker fees. So sometimes if you are using a broker to sell your property, then you would have to pay a fee. Usually the seller pays the fee to the broker, not the buyer. The buyer is like treated as, you know, let's find a buyer. So once you find a buyer, then you treat him like he doesn't need to pay anything. So you charge from the seller. Of course, you know, this may get priced into the price of the house. Bank fees for arranging a mortgage or for arranging an escrow account. Okay, an escrow account is for the deposit. So let's say a buyer has signed the papers that he wants to buy this house. The seller would make him put maybe 10% or some sort of a maybe 5% of the cost of the house into a specially designated account that they set up with a bank to guarantee that you know, that he means it. And then under certain conditions, if the buyer backs out, then the seller gets to keep this money. Or if he backs out under other conditions, he's allowed to take it back, then it all gets specified. You can imagine that there are cases where the buyer changed his mind because, I don't know, they decided to dissolve the marriage, and then the seller would get to keep the deposit, but if the seller didn't actually complete the building of the house, if it was a house in construction, but the construction company didn't fulfill on its duties to actually build the house in a timely manner, then the buyer is allowed to change his mind and he gets back the deposit money. Okay, so these rules would be kind of written in the contract. The escrow account would be managed by the bank, and yeah, it would work as expected. Risks. The risk when buying a property. Okay, firstly, you have a concentration risk. If you buy a house worth $5 million, and then your entire wealth in the world is $5.5 million, or even less, because you buy it with a mortgage. So let's say your entire wealth is the million equity that you have in the house, because $4 million you've borrowed from the bank, and then you have something in your pension plan, maybe another $2 million. So in total, your wealth is $2 million, but you're exposed to fluctuation in the value of the house, which is worth $5 million. So you have $5 million in a house, which is more than 100% of your entire wealth, which could be maybe just $2 million. But that's not really such a big deal in a country like Switzerland, or in any kind of Western country where house prices are stable. Unless, of course, you buy a very expensive house that in a very kind of, in an area where people get excited and lots of these new rich people move there, and then the industry, let's say it's a high-tech industry, then house prices have gone in the past quite rapidly in Palo Alto or other places in California, where during the dot-com bubble, and then when the bubble burst, the house prices also went down in these neighborhoods, and it wasn't so pleasant for people that bought a mansion for 10 million to see it go down to 7 or 8 million. But house prices don't usually go down so much, and in any case, you don't buy and sell them so often. But this concentration risk is maybe not that bad. The liquidity risk, okay? I said that I will be explicit what I mean whenever I said the word liquidity. It's important to me. But again, you're going to see that this relates to the basic definition of how easily an asset is convertible into cash. Okay? So a house is not easily sold for a reasonable price. If you want to sell it for what you think is the market price, it takes between 90 and 360 days. Okay? If you're selling a house in 90 days, you are most likely going to take a 5 or 10% discount on what is kind of considered the market value based on similar properties sold in the vicinity. Okay, so you're kind of stuck with it. So don't get married and divorced too often. You can change your house, so that could be a problem. Negotiation risk. This is what people really underestimate, and this is how people are sold onto houses. All the people that I know that have bought a house too large, they didn't do fully the math, they didn't fully appreciate the math, which I'll show you in a sec here. But they were also led to believe by the broker that sold them that they're buying this at a discount to the market value. Okay? By 10%. I don't know how they were convinced into it, but somehow they believe that they are already up 10% as soon as they bought it. And this is the negotiation risk, because buying and selling a house is very different from buying and selling Apple shares. Okay? You cannot really get it wrong when you buy Apple shares. You just, even if you put a market order, not even a limit order, you just buy it, whatever is the lowest offering price, you just hit it, then that's never more than 1%. Really, for Apple shares, it's much less than 1%, the bid-ask spread. Then you're never gonna get it. You're never gonna buy it at a higher price than what the market value is so much, and not even 0.1% higher. And you're never gonna sell it at that much lower price, because there's always so many buyers and sellers for Apple shares, because it's a kind of a commodity. Okay, you have so many buyers and sellers that when you buy or sell, the difference is very small. But this is not the case for a house. You know, it can go 100,000, or if it's really a big house, it can go 250,000 here or there easily, just by kind of the negotiation skill of the buyer and the seller. Especially if it's a spouse, then they're not really kind of certain who's the boss in the house and who's the boss when dealing with the outside world. It's not always the same person, okay? Sometimes married couple, there's a boss inside the house, and then there's a different boss when it comes to dealing with outside people. And at least they got it figured out, and that's good. But sometimes they don't fully understand they get it confused, because it's about the house, but they're dealing with an outside person. And sometimes the person that's the boss inside the house, you guys understand what I mean, right? Interpersonal relationships. The boss inside the house gets confused and takes over the conversation or the negotiation with this outside person that's looking to buy the house. And that could lead to critical mistakes in the negotiation. And then, you know, it can go 100,000 or 250,000 against you, just because the buyer is maybe an experienced business person and he knows the right words to say to kind of get the wrong emotions out of the people that are selling the house, and they've got it confused from the beginning who's running this negotiation, and he can go to the weaker link between them. And it can go 250 or 100,000 against them easily. That's negotiation risk. Taxes. There's an interesting thing called the owner's benefit, and there's something that for tax law, for anything that relates to taxes, you have this concept of a deemed income or a deemed expense or a deemed distribution. It means that it's something that we, the tax authorities, consider as income. We deem it, that's the word deem, we deem it as an income, even that it wasn't really an income for you. Okay, this is the owner's benefit. So 4.25% of 70% of the value of the house, that's the calculation. So let's say you bought a house for $1 million, take the number 700,000, multiply that by 4.25 every year, and you get to a number of somewhat less than, like 3,000. I don't know, how much money do you get there? You calculated, maybe it's like 28,000 or 20 something a year, which is a deemed income. Okay? So, yeah, about 28,000 Swiss francs in this example would be added to your taxable income, even that this is not really income, just because you own a house. It's okay, just think about it. Why would they do that? Not sure, but this is the owner's benefit. This is if you live in a house, so if you were renting it out, you could have been making so much money, but even if you're not, you need to pay taxes on this imaginary deemed income. And this is in Switzerland. Maintenance costs, as we said, are tax deductible. Renovations are tax deductible. Property transfer tax. Some cantons impose a tax when you buy and sell. The seller usually pays it. Okay. I think the seller usually pays it. It's almost always the case that the seller pays the tax, transfer tax. All right, so we mentioned the capital gains on property is taxable. There's this difference in many places whether it's your first or your second or your third home as far as taxes that you need to pay. So you can imagine that if it's your first home and you live in it, there's a difference between whether it's owner occupied or whether it's an investment property. So again, the government wants to tax us, and while they're doing it, they are bringing in these kind of social considerations, which is okay. And they say, well, if it's your second home, you need to pay somewhat more of a tax on it relative to the case whether if it was your first home. And if it's an investment property, you need to pay more taxes than if this was an owner-occupied home. So they want to kind of encourage home ownership. They put incentives to increase home ownership. And it's been shown that increased home ownership reduces crime. Yeah, but you shouldn't make too much of these academic studies. The wealth tax is applicable on the net value. We discussed that. Mortgage. All right, so most people will have to take a mortgage to finance a home. And actually, if you think about it, then even if you have the money to buy a house straight out, and I'll show you the math, and you know how to invest your money in stocks and bonds and loans and make a positive rate of return, then you really actually kind of want to take the max amount of mortgage, because the interest rate that you would pay on the mortgage would be less than what you would make on your investments elsewhere, especially if you give it enough time. Then it makes sense to take a mortgage even if you can afford to buy it straight up cash. Right, the tax deductibility of the mortgage, the interest payment is allowed to be deducted from your taxable income. Affordability. Okay, you can click. This is a very nice calculator to calculate your affordability, how much income you have, and whether this is sufficient to take a certain amount of mortgage. So there's two ways of looking at it, and if you guys want to think as a lender, okay, in this course you will think as a borrower and as a lender, okay, because it's critical to understand both sides of the transaction. Then there's always two ways for a lender to evaluate the riskiness of the loan. Okay, one way to evaluate it is the balance sheet view of things. Okay, so then almost always the measure is loan to value. Okay, so if you're buying a house worth 100, you take a mortgage worth 80, and you bring 20 cash from home, then this would be 80% loan to value. So this would be the loan, this would be the value, so it's 80% loan to value. Okay, usually 80% loan to value is the max. It's still safe for the lender. It's and it's still affordable for the borrower, and that's one measure. Okay, another measure, which is kind of more granular and more important, is the income statement view of things. Okay, the flow. Okay, this is at a given point in time, and this is kind of over a period of, say, 1 year. So over a period of 1 year, you say paid an interest, and here it's imputed at 5%. Okay, 5% of the 80 is 20 per year, is it? No. That seems wrong. No, that's really wrong. Let me fix this. Oh, maybe this is a different example. Okay, so this is a different example. But yeah, so this is a different example. It's not related to these numbers, but just different numbers. But then these proportions are more or less correct. Then let's say you take so this would be 5% times 20. So let's say you take a $400 mortgage against a 500 value of the house. Then you need to pay 5% interest. Now you don't really pay 5% because the mortgages are more to the range of 2% per year interest rate. But what the banks are forced to calculate before they lend you, they do this calculation of affordability, whether you can afford to repay this monthly mortgage payment. Okay, and then they say, well, even if we only charge you 2% per year, we need for the affordability calculation to calculate as if it was at 5%. So this would be maybe a 400 Swiss franc mortgage, and then the imputed interest payment would be 20, amortization would be roughly 10, maintenance costs would be again 1% of the value of the house would be roughly 10, and then maybe your gross income is 100, and then this would be a green light because it must be more than 33%. Must be no more than 33%. I need to fix this. I'm added this late night, so sorry. Okay. So if this would be a red light because the cash use is more than 33% from your gross income. And then they say if it's 33%, if it's more than 33%, then it's a no-go. If it's less than 33%, it's okay. So the amount of money that needs to come out from your pocket would be an imputed 20 plus 10 for amortization. Amortization is the principal reduction. Okay, you pay your interest, but you also pay your principal. And your maintenance cost, together that would be 40, which is more than 33% of your gross income, then it's a red light. It's a no-go on this affordability calculation. Okay, this is a rule of thumb. You know, in some other countries you can, or if it's a private lender, then he's not subject to this exact rule. But this exact rule is actually imposed on the banks, I'm pretty sure. But this kind of calculation is repeats itself everywhere in lending. Okay? Yeah.
So I have question, maintenance and amortization should be together 1% of the price of the house, I think.
No.
For the calculation.
In this example,
Normally to calculate the 35%, you take only 0.5 amortization and 0.5 maintenance, 1% together.
where do you take this from?
I worked for a company which makes some hypothec.
Okay. All right. I'll try to look at the numbers. I mean, this is a hypothetical example. But if you click this calculator, you can play around with it. And it's more or less, this is the rule, that it's 33%, no more than 33% your cash out for, together, for the imputed interest, the amortization, and the maintenance cost should be no more than 33% of your income.
Yeah, that's true.
That's true.
That's true, but they take only 5% of the hypothec, of
Yeah.
the volume, and 1% for the amortization and maintenance.
Together.
To get 1%.
Or.
Yeah. So 1% for the price of the house and 5% for the volume of the hypothec.
Okay, yeah.
I think so.
Here I put 1% of the value of the house in maintenance, 2% interest, but this is kind of an economic calculation, and you can see here the amortization. Well, let's try to figure it out in a bit. So here's just for orientation, let's call it, a chart of the interest rates on government bonds in Switzerland, and for comparison also the interest rate on an instrument which is used to finance mortgages. Okay? So you have to ask yourself, how does the interest rate that the banks charge me as a homeowner and as a borrower, how do these get determined? Well, it depends on the cost of financing for the bank. You know, the bank also borrows the money, mostly from us depositors, or also in the capital markets, and they need to pay a certain cost on that, and then they put some profit margin above that, and that's the price we pay. But then the cost to finance for the bank is directly related to the cost of us to borrow. And then you can see for orientation how this thing evolved over time. You see 14, 15, 2016, 2017. I haven't extended it to 2018, but it remained more or less in this ballpark. Then you see it's about 0% for them to borrow money from the capital markets and then to use this money to give out mortgages. Okay, so that's why it costs to borrow for us is around that, plus 1.5 or plus almost 2%. And then interest rates throughout the economy are related to each other, because when investors think where they're going to invest the money, and if it's similar levels of risk, whether it's a mortgage bond or it's a government bond, the government bond is just a little safer than, say, a mortgage-backed security, but they would move up and down kind of together, and the spread between them would be more or less constant. Okay, so you see over time also the interest rates on government bonds went down. And this is January 2015, where you had the peg to the euro be kind of, they canceled the peg to the euro. So on the same day, interest rate went down a lot. And the things are related. We'll try to get there. Yeah, there's one thing that we forgot, when we calculate, and this is the way, this is the one thing that many people forget when they buy a house, when they consider whether they're gonna rent or own, is the cost of equity. Okay? The cost of equity is the alternative return that you're not making on the down payment. So let's say you work in a high-paying bank job, and you're making your 250 or 500, your 600,000 a year from your 9-to-5 day job, and you've saved $1 million, and with this $1 million you buy the home of your dreams that costs $5 million because you took a $4 million mortgage. And that's what most people do. Most people buy a house with $5 million because they save up cash up until they have $1 million, and then they buy the biggest house they can that costs $5 million because the maximum is 80% loan to value. And this is quite often for people to buy a house for $5 million with the $1 million saved capital. And what they don't really take into consideration that on this $1 million, they could be making a rate of return, okay? They're not investing this $1 million into stocks and bonds and loans where they can easily make 5% a year on average over time. And instead of that, they're locking this up in the house. But on the other hand, the house price also can appreciate. Okay, so it's also kind of an investment, right? But, and this is the big but, this capital gain of the house price going up, does it really mean to you the same as if you invested in a basket of stocks globally and that basket of stocks appreciated over time? I argue that it's not the same, because the basket of stocks you can easily sell or sell a little bit and use the cash proceeds to finance your consumption or your retirement, but your house, unless things go really, really badly, it's really the last resort that people would never sell it. Okay, so when people buy a house, they're usually stuck with it for the rest of their lives from their own choice and their own preference. And also because it's not as easy to sell it for the price they think it's worth. It's really not easy to sell it, especially if it's a luxury home. Then they come to value it more than any external buyer because they're emotionally attached to all the furniture and stuff inside. But a buyer wants to kind of bring his own stuff to get attached to. So then it's always the market price is somewhat lower or maybe significantly lower than what they imagine the price is. And anyways, they never intend to sell. So even if the price of the home appreciated to 6 million from previously 5 million, and now their equity in the house, instead of 1 million, has gone up to 2 million, right? This is the calculation. So let's say the value of the house went to 120. Your mortgage, say it's still at 80 because you just pay interest but no amortization, and your equity would be now 40. Okay, so 20% increase in the house price with 80% loan to value would be 100% increase in your equity, which is great. So maybe you're twice as rich, but you can't really easily tap into this wealth to finance your retirement because it's locked up in the house. All it really means is you live in a more expensive house, in a more expensive home. Okay, so that's the one big miscalculation that people do. Okay? They would take their million saved, they would buy the biggest house they can, and then they would kind of convince themselves that because house prices appreciate, and they do, that this would make them richer, and it will on paper, but it will not be able to finance their retirement unless they take one of these two or three options, which we're going to discuss, which are not so kind of easily attainable or desirable. And this is the big miscalculation. This is why they have to kind of stay until 60 plus retirement age, even that they've been making 500 or even $1 million a year. And this is the main kind of reason why people cannot retire if they buy such a big home, because they fantasize about the capital appreciation making them richer, but they have absolutely no intention to ever sell the house, and so this doesn't really help them. And let's do the calculation. Now, the cost of equity is the entire alternative return that's been earned by investing in other assets. You can think about it this way. This would be the more conservative approach that I'm saying, because if you don't have any intention to ever sell the house, and then the equity capital is just stuck there, and so you should assume as the cost of equity that the entire alternative return that you are not making by investing into stocks and bonds and loans. To model this in your Excel spreadsheet, simply assume zero house price appreciation. Okay? In your Excel spreadsheet, you can just assume zero house price appreciation, and then that's how you take care of this. That's how you model this consideration. The second approach, okay, own equity accruing in the house due to price appreciation, it can be monetized in one of the following 3 ways. Okay, you can sell the house and rent instead. Okay, theoretically you can stay in the same house, but someone else owns it and you just pay rent, and now you have all this cash which you can consume when you're retired. Okay? Or you can invest it in something relatively safe and then consume the interest or consume the the interest and the principal in your retirement. You can do that. Sell the house and rent instead. Or, so this is one way for you to tap into the equity in your house. Okay, you need to, your house is worth a lot, especially if it increased in value. But unless you sell it or borrow more against it, then you can't really do anything with this capital locked up in there. Because you have this issue, you're 60 or you're 50 or you're 30 and you want to retire, then you need to start using your capital in a different way. But if it's locked up in a house, then yes, it has this value. Some other person is willing to buy it for this amount of money, but you can't really tap into that unless you actually sell. Yeah.
So does A say that like for the whole life plan that we would be richer or smarter if we would rent?
Depends on the price. Depends on the rent and depends on the cost. I'm going to do this little calculation. We can do that. I don't want you to kind of impose on you any such conclusions, but I do want to impose on you to have to do this calculation, decide for yourself, and you tell me. Okay, so let's do this like next slide. Next slide we're going to do this. Sorry. So just to finish these two, so let's say again if your house price increased to 120, and let's say your mortgage, you just paid interest and no amortization over time, so you still have an 80 liability, but then now your equity is worth 40, all right? And that means now that your loan to value is less than 80%. So theoretically and practically, you can borrow more money against the house to bring up the mortgage to the value of the house ratio back to 80%. Okay, so you can do that. That means that you have now the capability to borrow more money against your house. And then this cash you can use to finance your consumption when you're retired. All right, so that's one way. This is called a home equity loan or home equity line of credit. Okay, you would borrow more money against your existing home. And you can read the different kind of comments I put here. The point is that you can increase, as the house price increases, the leverage decreases and the loan to value measurement decreases to maybe 75%, and then you can borrow another 5% of the value of the house to bring back the financing mix to 80-20. 80% mortgage, 20% equity. And another option is to refinance it with the entire first mortgage altogether. So here I'm talking about a second mortgage, and here I'm talking about refinancing the first mortgage. So you would take here, so this is still 80, but you can push it up to 95 or so, right? Or up to maybe almost even 100. You can push it up to 95 because the value here is 120, and the value here is 40. Then here it's still 80, but you can push it higher to about 95 because the value of the house increased. So either you take a second mortgage, or you take another mortgage, first mortgage, which is for 95, and with this money, you pay back 80. With 80 of the 95, you pay back the first mortgage. Okay? And now the 15, in some cases, you would be allowed to use for consumption, but in most cases, it actually wouldn't be allowed. Yeah, read these different points. I think it's interesting to think about it. I think it's important. So I want to do this table because this is important. I've seen so many people that they come to me after they get fired from the bank they come to me after they've been fired from the bank, and I tell them, you've been making, what, 500,000 at least a year for the last 20 years? Or you've been making 750,000 a year for the last few years, but before that you worked for the bank for another 20 years and it grew kind of steadily. Where is the money? You tell me you have nothing? Well, yeah, I have a $7 million home and a huge mortgage. And they, when they bought it, thought it was the right thing to do. Why did they think it was the right thing to do? Mainly because of their imagination about the capital gains being something that they would be easily able to tap into, and other considerations. But let's do the calculation. So it's usually the case that high earners would buy the biggest house they can afford as soon as they save $1 million in cash. So they would buy a $5 million home with $1 million down payment and a $4 million mortgage. This is the most common case for these high earners. And then they cry when they get fired at age 50 or even 60 and cannot retire, even after having earned $400K a year on average in the last 20 years for having a 9-to-5 job. You wouldn't believe how many people like this come to me. And so let's just do the calculation. So let's say you live in a kind of humble apartment with your, 1 or 2 kids. You pay 3,000 francs a month. That's a nice apartment, okay? You can even get a decent apartment in Zurich or a proper house just outside of Zurich for 3,000 francs a month. So that would be, everything here is yearly calculations, 36,000 a year. Let's say you pay Nebet cost 200 a month, so add that. And the value of this house would be roughly 1.5 billion, okay? And that's more or less the prices in the market. So an apartment or a house that you can rent for 3,000 a month would cost you about $1.5 million to buy. Okay? This is not a theoretical calculation. This is more or less the prices in the market. So you take what you see in the market and you think for yourself, what should I do? And then your monthly payment would be 3,200 and your yearly cost would be 38,000. On the other hand, if you go ahead and do what your stay-at-home wifey or hubby told you, and you bought that $5 million home with that $1 million cash that you've saved, and then what are the costs for this, right? So let's say you pay 2% interest on the 4 million mortgage. That's 80,000. Okay, what I forgot here is the tax deductibility. I should really have here less 25% of this amount, so that you need to pay less in taxes. All right, so this amount is tax deductible, so you need to pay at the 25% marginal tax rate, you need to pay 20,000 less in taxes per year. So this should be actually 60,000, but never mind, you can just leave it at 80,000, because what I've put here for the cost of equity is just 5% of the million which you're not making in returns by investing in stocks and bonds and loans and maybe other real estate for investment. Okay, that's kind of conservative. Maybe it sounds a lot. Why? I just showed you the interest rates are next to zero, but these are very risk-free rates. But there are kind of risky rates out there, but if you can get diversified over so many of these risky assets, then it becomes quite safe. Then trust me, and I'll show you when we get there, that you can pretty easily make 5% a year on average over time by investing into all these other assets. So assuming 5%, and some people get more, okay? You know, expert financiers, they're aiming for 12% per year. And that's possible, you know, you don't need to be a genius. It's very much possible. And the rich families have been making at least 12% per year for generations in real estate or other investments. It's possible. So let's take something that's still quite conservative. It's 5% per year cost of your equity. And your maintenance cost, which people really underestimate, is about 1% of the value of the home per year. It's about 50K a year that they spend on, you know, the gardener, the cleaning lady. They buy a huge house, you need a cleaning lady. All these, the robot that cuts the grass. So how much time net we had class time net?
90 minutes.
No, but this, did we have the 90 minutes? We had started at 15, and then we had a break, and now it's a quarter to?
No,
No,
it's 12.
Now it's 12. Okay, so we're done. All right, thanks very much.